John D. Rockefeller once said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." The richest man in American history built his entire empire on one principle: own things that pay you. So here's my question. Why is everybody running away from dividend stocks right now? We're talking about companies that have paid dividends for 25, 50, sometimes 60+ consecutive years. Through world wars, through the Great Depression, through 2008. And right now, investors are dumping them like a bad Tinder date. So today, we need to talk about what the heck is actually going on, because the answer is both fascinating and a little bit terrifying. To understand what's happening right now, we need to go back, way back. 1970s America. Inflation is ripping through the economy like a chainsaw. The Fed raises interest rates to 20%. 20%. Let that sink in. Your savings account is paying you 20% annually. So what happens to dividend stocks? Nobody wants them. Why would you buy Coca-Cola yielding 3% when your bank account is paying you 20%? Dividend stocks got absolutely crushed. The Dow Jones went essentially nowhere for an entire decade. Investors called it the Death of Equities. Businessweek literally published that as a cover story in August 1982. And what happened right after that cover story? The greatest bull market in American history began. But here's the twist. We're not in the 1970s anymore. We're in something weirder. Here's where it gets interesting. Fed rate chart versus dividend stock performance. From 2009 to 2021, interest rates were basically zero. The Fed kept money basically free. Dividend stocks were kings during this era. SCHD, one of the most popular dividend ETFs, delivered 14.1% annualized returns over that period. People called dividends the new bonds. And then, March 2022 happened. The Fed raised rates 11 times in 16 months, going from 0.25% all the way to 5.5%. The fastest rate hiking cycle in 40 years. And suddenly, dividend stocks had a problem. A big one. Why buy Realty Income, a beloved dividend stock yielding 5%, when a US Treasury bond, backed by the full faith of the US government, is paying you 4.8% with zero risk? That's the villain of this story, the risk-free rate. When do nothing and park your cash starts paying almost as much as owning a business, dividend stocks lose their superpower. And the numbers show it brutally. SCHD dropped over 20% from its 2021 peak. The Dividend Aristocrats Index, companies with 25+ years of consecutive dividend growth, underperformed the S&P 500 by nearly 30 percentage points between 2022 and 2024. 30 points. Meanwhile, the S&P 500 was being carried by 7 companies. You know their names: Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, Google, the Magnificent Seven. None of them are traditional dividend payers. Nvidia's dividend yield? 0.03%. Basically rounding error money. So the market wasn't rewarding income, it was rewarding growth. AI, hype, and dividend investors were standing at the party like someone who showed up in a suit to a pool party. Technically correct, completely out of place. So where does that leave us right now? Here's the thing nobody is talking about. The tide might be turning. The Fed has already started cutting rates. We went from 5.5% back down toward 4%. And if the economy slows further, more cuts are coming. And here's what history tells us about what happens next. Every single time the Fed has entered a rate-cutting cycle, dividend stocks have outperformed. In the rate-cutting cycles of 1995, 2001, 2007, and 2019, dividend-focused strategies beat the broader market within 18 months in 3 out of 4 cases. Why? Because when do-nothing stops paying 5%, investors start looking for yield again. And suddenly, that Realty Income dividend looks a lot more attractive. SCHD's current yield is sitting around 3.5%, with a 10-year dividend growth rate of 11% annually. Meaning if you hold it for a decade, your yield on cost could be sitting at 9, 10, even 11% on your original investment. That's not a savings account. That's a money printing machine you own. But, and this is important, we're not out of the woods. Inflation is still sticky. The 10-year Treasury is still hovering around 4.5%. And if rates stay higher for longer, dividend stocks could stay in the penalty box for another year or two. Nobody knows. Anyone who tells you they know is lying or selling something. The takeaway. Here's the honest truth. Dividend stocks aren't broken. They're just out of fashion. And in investing, out of fashion is often exactly where you want to be looking. Rockefeller didn't build his wealth chasing the hot stock of the year. He built it by owning things that paid him, year after year after year. The market right now is obsessed with AI, momentum, and get-rich-quick stories, which means boring, cash-generating businesses are sitting at a discount. Is now the perfect time to go all in? Maybe. Maybe not. But if you're the kind of person who likes being paid while you wait, dividend stocks deserve a serious look right now. Not because they're exciting, because they're not. As always, do your own research, manage your risk, and remember, the goal isn't to get rich quick. The goal is to get rich for good. See you in the next one.